In today's episode, we'll explore how a couple can effectively invest their 70 lakh corpus from selling their flat, aiming to double it in 10 years. We'll then look at a portfolio restructuring for someone concerned about market corrections. For our younger viewers, we'll discuss smart ways to invest a significant annual bonus. And finally, we'll tackle an important health insurance situation. What happens when you miss renewing your family floater policy and how to restructure your coverage effectively. Hi everyone, I'm your host and welcome to another episode of Kash Queries with Krutika. This show addresses real financial questions from people just like you who are trying to make smart money decisions. Look at today's questions. We have got everything from retirement planning to portfolio management, from lump sum investments to health insurance. These aren't theoretical scenarios. They are real situations that people are dealing with right now. Sometimes it's about making the most of your savings, like a first query about doubling 70 lakhs in 10 years. At other times, it's about protecting what you have built, like our last question about health insurance coverage. One thing that I have noticed is that money decisions can feel overwhelming, whether you are managing a large bonus or trying to protect your family's health. That's exactly why we created this series, to help you navigate these financial crossroads with confidence. Every question we receive is kept anonymous because, let's face it, talking about money isn't always comfortable. So let's dive into our today's episode. Today, I'm joined by Mithilesh, who will be reading out your questions. Over to you, Mithilesh.
I sold my flat to create a corpus for my old age. My husband will retire in 7 years and would like to invest in safe and secure returns. The amount is 70 lakh rupees and we want to double it in 10 years.
The rule of 72 can be applied to calculate the returns required to double money in a specific period. Your investment should earn around 7.2% every year to meet the objective. Government schemes like Kisan Vikas Patra or National Savings Certificate can be used for this purpose. KVP and NSC will take 10.4 and 10.5 years respectively to double the amount invested at a current rate of interest of 6.9 and 6.8%. However, the interest is taxable at slab. You should ideally allocate part of the funds towards growth assets such as equities in addition to government schemes. An allocation of 20 lakh in equity mutual funds can generate around 53 lakhs, assuming a CAGR of 10%. Do not panic and exit during market downturns. Invest in a combination of large cap index funds such as Nifty 50 and Nifty Next 50. Wow, that was a question very important for people who are looking to double their money. Let's read out the next question.
I am 50 and investing in mutual funds for the past 3-4 years. About 80% of my investments are in debt funds and rest in equity funds. I have some investment in gold and FDs. I read there is a market correction expected and we should reduce equity exposure. However, the return from debt funds over the past 9 months has been very low. I don't need any big amount in the next 5 years. Of my total savings, 50% is in mutual funds and the rest is in FDs, gold, real estate. How should I structure my mutual fund portfolio? Should I take out the money from mutual fund and keep it in bank FDs for the next 1 year?
It is difficult to predict market corrections. Looking at the current situation, there can be volatility and corrections, especially if companies don't maintain strong growth and earnings. In many cases, valuations still look a bit stretched, so it is better to be cautious. Since you have a good exposure to debt mutual funds, gold and real estate and FDs, and with only 20% allocation towards equity, I don't think you should reduce this part of your portfolio. However, given your age, I would not recommend more than 50% allocation towards equities. Apart from liquid and ultra short duration funds, keep the maturity profile of your other funds to a maximum of 4 to 5 years to avoid mark-to-market volatility. I don't recommend dynamic bonds, and you can look at investing in a floating rate category. Since you already have exposure in FDs and all your cash flow requirements are fulfilled through them, you can let your equity and debt mutual fund and gold portfolio be the way they are and let them grow over time. During decent correction pockets, you can think of increasing your equity exposure. You can also look at introducing balance advantage or dynamic asset allocation funds, as they are called, in your equity portfolio, as these funds do not require you to time normal market corrections. Lastly, don't go overboard in investing in gold and real estate. Great question. Let's move on to our question number 3.
I'm 30. I received an annual bonus of rupees 50 lakh and want advice on how to invest it. I have monthly SIPs of rupees 75,000 equally distributed across debt, liquid and equity fund categories with a total mutual fund corpus of about 14 lakh rupees. I am invested in SBI Banking and PSU Fund, SBI Blue Chip, ICICI Prudential Balanced, HDFC Hybrid Equity, HDFC Index, HDFC Index Nifty 50, HDFC Low Duration, Parag Parikh Flexi Cap, Tata Liquid, ABSL Liquid, DSP Equal Nifty 50, IDFC BPDF, Axis Focus 25, Axis Long Term Equity, Axis Blue Chip, Mira Asset Emerging Blue Chip, Quant Liquid, PGIM India Global Equity Opportunity and PGIM India Ultra Short Term. Should I pick a few funds from these existing SIPs and invest the lump sum?
You have not mentioned the risk appetite, investment objective and horizon. We assume your risk appetite is moderate to aggressive and the goal is wealth creation. We suggest you invest 40 to 45 lakh in dynamic asset allocation or balance advantage funds. This will allow significant participation in upside of equities while limiting volatility and offering superior risk-adjusted returns compared to pure equity funds. You can divide the corpus among ICICI Prudential Asset Allocator, Nippon India Balance Advantage and Kotak Balance Advantage Fund. Keep 5 to 10 lakh rupees in liquid funds for emergencies. As far as your existing investment is concerned, it is distributed amongst debt, hybrid and equity segments. If your horizon is long and the goal is wealth creation, shift your entire SIP amount into equity-oriented schemes as equity has a potential to deliver superior returns in the long run. The 75,000 can be equally divided amongst Axis Growth Opportunity, Mirae Asset Emerging Blue Chip, Nippon India Multicap, Parag Parikh Flexi Cap, UTI Flexi Cap, Kotak Emerging Equity and IDFC Sterling Value Fund. Review your portfolio at least once a year. Wow, that was quite a lot of fund suggestion to the viewer, right? Great, let's move on to our final and last question.
I bought a family floater policy covering my wife, 2 kids and my parents in 2010 where the oldest person's age is 70 and continued paying premium till 2020. I forgot to renew the policy in June 2021. What should I do now?
A health insurance policy offers a grace period of around 30 days after the due date. Since the period is over, you will need to purchase a new policy and all waiting periods would reapply. While you bought a single policy to easily manage coverage for your entire family, this may not be the most efficient solution. Considering the different levels of health risk associated with different family members, it is better to take a separate plan for yourself, your spouse and children, and a different one for your parents. This will not only help you reduce premiums but also increase the overall coverage. There are a host of insurance providers available in the market, but do make sure that your plan comprehensively covers everything. Wow, with that's a wrap in today's episode. We have covered quite a range today, from investment strategies to insurance planning. What strikes me is how each situation needs a tailored approach. Whether you are planning for retirement, managing a windfall, or protecting your family's health, there is no one-size-fits-all solution. If you face a similar financial decision, remember, it is perfectly normal to have questions and concerns. That is why we are here, to help you make informed financial choices based on real situations and practical solutions. So if you got a financial question you'd like answered, feel free to email me at this email ID. Your question might not only help you, but could also guide others facing similar situations. Until next time, remember, every financial journey is unique and you don't have to navigate it alone. Take care and see you in the next episode of Kash Queries with Krutika.